RCM Technologies, we got a question on it from a client. They are symbol RCMT on the NADSAQ. The company offers specialized staffing solutions for specialty healthcare, engineering, and life sciences, as well as information technology. The company offers either short-term or per project solutions, as well as long-term multi-contract positions over a longer period of time. The company is primarily in the US, but they do have some operations in Canada and Europe at this time. The question asked specifically, are they seeing catalysts in expanding into different regions? They specifically named South America, as well as does the company have a economic moat, which I'll get to in a few minutes. The stock is trading up substantially over the past year, up 110%, and is trading at $22.30 a share at a market cap of $177 million. Looking at the financials for the last year, so 2023, starting with income statement, revenue decreased 7.5% to $263 million from $285 million. This is still an increase compared to 2021 of 29.1%, as the company did see a substantial increase between that 2021 and 2022 period, and it has since slightly come down since that peak. However, gross margin still remains steady at 29.1%, which is good to see, as sometimes when you see that big peak and then the contraction after, you'll start to see margins slip as well. But that doesn't seem to be the case, at least for the overall business. You have seen a bit of the mix between the three segments, where a couple of them have risen and one of them declined. And so that is something you do want to watch when you want to dive into it a bit deeper. If you are considering this investment, is really watch those margins to see if they're contracting or expanding. Operating income fell 17.7% to $23.7 million due to that lower gross profit, slightly offset by lower SG&A by about $1 million. Net income fell 19.4% to $16.8 million, or $1.96 per diluted share, due to the previous reasons, as well as they have higher interest expense. When you see a high interest expense like this, from going from $400,000 to $1.4 million, you want to look at that, and we want a moment. The net margin was 6.3% for 2023, which is a decrease from 7.3% from 2022. Like I said, we want to look at the debt and why the interest is increasing. So RCM, they hold a cash position of $6.3 million, and they have a line of credit at the end of 2023 of $30.8 million. So that's a net debt position of $24.5 million. As well, you can see that line of credit increased substantially from $8.8 million. So big increase. So the line of credit is where the interest expense is coming from, partially due to the size, but more so to do with the interest rates as the debt is floating. The effective interest rate for 2023 was 6.5% compared to 2.2% in 2022. So nearly 3 times that just interest rate, even if their debt was steady, and that accounts for the majority of that difference. As well as the size of outstanding credit line does fluctuate quite a fair amount throughout the year. And since the balance sheet is only, remember, a snapshot in time at the end of the quarter or the year in this case, and it being 3.5 times the size, but they're turning that over multiple times per year, you need to look a bit deeper, and then you realize, it's more just the interest rate went up versus the actual debt level. So even though you are seeing that substantial increase under borrowings of lines of credit, it does fluctuate a lot throughout the year, and the majority of the actual interest expense increase was purely just because of interest rate increases, not the actual debt level. But that is still obviously something you want to watch if you see the borrowing stay high over an extended period of time. But if it does fluctuate a lot in the quarter, you need to give them some leeway because it is a snapshot in time. Part of the reason for that increased line of credit, though, is a higher accounts receivable, as the company has had slower collections, but did note in their conference call that the collections have at least increased pace during Q1 so far. This is something to watch out for, as companies that have issues collecting can quickly have issues cascade that they need to cover. They need to take more debt on to cover shortfalls. And then that is in a high interest rate environment. Obviously, that creates a lag on earning. And then eventually, if they aren't able to collect, you could see write-downs, which means they're either not going to collect the full amount or less, or as for the accounting principles, it might be past 90 days, even if they are still, in reality, expecting to collect all, a delayed collection. As well, hitting the cash balance, the company did repurchase a substantial amount of shares, 1.8 million shares for $25.8 million, which obviously does put a bit more pressure on the cash reserves, because that's a substantial amount for a company this size. So on to the questions. So for expansion at this time, the company doesn't have a presence in South America. They did mention in their Q3 conference call that it was of interest to expand there, but that would be down the line. It's really just in its early phases, it seems like. And that would be, if we were to call management, that'd be something we would ask, is how they're going to expand and what areas and so on. However, in 2023, they did have their energy services division, which is under their engineering, open office in Germany. So as far as regional expansion, at least for 2023, Europe might be the place to look, and that could be the place to look going forward, as they already do have a bit of presence there. It want to be a full new region to them. They have Serbia as well as Germany. And then, but past geographically, what you would want to watch as well is what specialty areas or what staffing they are really providing. Are they expanding their breadth? Are they expanding vertically? Not just the geographic region, because obviously within the US, they can have staffing solutions for a myriad of different industries. As well, a comment on the economic mode of the company. The staffing industry as a whole is very competitive, quite fragmented. It can depend on the region and so on. And that's why you'll see things like tuck-in acquisitions, bolt-in acquisitions, that sense, because they can't just grab something, small company, and put it in their house. But that's also shows kind of the weakness, because it is a very low moat, because you have all these companies, you have quite a bit of competition. So for example, they offer us nursing staffing solutions, which is highly competitive. We actually have had, I think, a couple of companies under our coverage over the last couple of years within just nursing solutions. Just to give you an idea, it is a competitive space. So you do see, if you're looking at a moat, an economic mode, that would lower it. You're seeing a fragmented, which normally means competition is a bit higher, but then they can offset a bit with those more advanced industries. So if you have something very advanced, you have the specialty within that industry that will provide the higher margins. It'll be a bit more restrictive as the industry is more niche, and that's where you'll really see a better moat. But it really depends on the service and what specific ones, and you see quite a bit of variance just even within the company. So the company as a whole, I'd probably say, has a weaker, maybe a bit stronger than some other staffing solutions, because they do have those specialties. But overall, it's not a super strong moat like you'll see in something completely different, like a NVIDIA or something like that, where it's obviously a strong moat at this time. But moving to valuations, the company trades at a trailing P of 11.4 times, an EV/EBITDA of 8.1 times, and a trailing price to free cash flow of 17.8 times. The valuation, I would say, is reasonable, maybe a touch too high, as the company has had great results over the past, from that 2021 to the 2022, but that was largely due to the COVID bump more than anything in nursing solutions. But the growth before that was really non-existent to low, and you can see a 10-year graph that I have popped up here. You'll see this is revenue and net income per share, or EPS, and you can see it's relatively flat. And then you'll see that slight decline at the start, because no one was really working in that 2021. So obviously solutions had an issue. And then you see that big jump up in 2021 and 2022. And obviously now we're coming back down a bit. But management they're still guiding, at least in their conference call, double-digit adjusted EBITDA growth for the year. So that will be something you'd want to track going forward. Are they actually going to hit that growth level? But moving to, and concluding, I should say, the company really just came off a great 2022, and 2023 is still good compared to 2021 or previously, but it is starting to show some weaknesses. They do to actually have a downsizing over their contracts, because the people who they were supplying the employees to had their project size decrease, so it obviously reduces their headcount that they supply. And just seeing issues like that crop up. And then they have the interest rate sensitivity, and just the natural part of the business being margins are low. So when you have that interest expense, they'll start to strip away. And then if they have a bit of the revenue decline, you have that loss of economies of scale, which can hit it as well. As well, you'd want to watch out for more than just the GAAP earnings. Like I was saying with the accounts receivable, you want to watch are they collecting? Are they seeing any write-downs? Are they seeing delays? Any discussion around that is important to watch with this, because if they stop collecting, it doesn't matter what their GAAP earnings were for the prior quarter. Once that write-down comes and they no longer expect to collect, not saying it will happen, that obviously means those previous GAAP earnings were overstated, and then the valuation in reality should have been higher than what it is. So really, I would say the valuation is reasonable, maybe a bit high given the risk, but the concern would be if you see a continued contraction of earnings back to low single digits, mid high single digits, similar to historic levels. But for now, I really just monitor the company to see if they can come out of 2023 a bit stronger, or sorry, 2024 a bit stronger.
Yeah, and
And I'm
that's
hoping
the
of you guys.
thing. Like they really had to lap, like such a tight labor market in 2022.
Mm-hmm.
Like, for example, like there's a company that's been on our radar for some time, Hudson Global Inc. And looking back at my analyst notes as we were doing, our sweep through, thousands of U.S. companies, like the company was net cash. It was trading at 17.30 at the time, $17.30. Again, they're a talent solutions or recruitment provider. They are profitable. And I wrote here, they could benefit from the work shortages that we were seeing, but I also say, but maybe more of a short-term trade. So that's the thing where, again, we're not traders, we're long-term investors. That's the thing we saw, even if you were looking at Hudson's financials here, we saw a good 2021. We saw a really great 2022. Well, now we're in 2023 and they're not able to lap. So we're all of a sudden, or they're not able to, post higher numbers in 2022. So, yeah, the stock went up. Hudson went from, I think, $17 to 30, 34 or somewhere in there, but it's back down to 18. It's right back where it is. So that's the thing. And trying to predict that the labor market is going to remain tight for a significant period of time is anyone's guess, in my opinion. But yeah, I think that's really the story. There is the fact that such a good 2022 with the tight labor market. The amount of analyst calls that we would jump in, and that would be our question: how was hiring? And the amount of difficulties that they were going through was pretty tremendous. But trying to lap those record numbers in 2023, obviously a lot of these companies can't do that. And looking to 2024, like you said, Brett, like that's really going to be where the rubber meets the road, to see what they can do.